Guys, AMD just reported, Intel reported last week and they crushed the expectations or something and they skyrocketed. AMD just reported 67 cents per share in profit versus 65 cents, 5.6 billion versus expectations of 5.58. Now I want everybody to know those expectation numbers changed within the last few hours, and here's why. It is commonly known that analysts and these guys can change their expectations up until announcement, and they want to be as close as possible to it. So this is my conspiracy theory in me, like, okay, why are these things changing? It was still good. They still did a great job. One of the things you're going to know about this is the data center data they get. Now, the stock was down 4% at one point, then up 2.5% or something, and now it's basically even. So, look at this. Look at this, Tim. Now it's literally 0.3%. This is all over the place. Guys, the chip industry is going to be tough for a while. They had 2 years of absolute bliss and amazing, and there's a lot of changes that are going to happen in it. The U.S. is being very aggressive about making sure that chips will be built in the U.S. So the government's giving those that chip incentive plan. They're out there. So AMD is a company I've been looking at for a while. The all-time high is November 29th, 2021. So less than a year ago. 165 a share. It's currently at $59.81 per share. $60, guys. And this is the company, Paul, you're an idiot for liking Intel. Intel's not down 70% because of valuation. So let's go to the analyst. Let's go to the 8 pillars here first. Guys, tons of shares outstanding. More debt than we'd like. Free cash flow growth, net income growth, revenue growth. So I will say this. It's a growing company. And you should value growing companies different. That's why we create our stock analyzer tool, because growth is an important part of investing, whether it's value investing or not. And by the way, I believe all investing done well is value investing. And growth is all about valuing the company based on a future growth potential, but giving yourself the ample margin of safety to go buy it for less money. This is their actual press release. And like I said before, data center was huge. Each grew significantly year over year. Cash and operating cash flow increased year over year, which isn't very hard. But let's look at this. So $5.6 billion, and with gross margin of 42%, net income of $66 million, and diluted earnings per share of 4 cents. Now here is the diluted earnings per share on a non-GAAP basis of 67 cents. So let's go look at right here. Revenue overall up 29%. Gross profit up 13%. Gross margin now is down 610 basis points, which is 6.1%. Operating expenses up. So figure out what they're doing. Are they spending a lot of money for growth? What's going on here that's causing their operating expenses to be up 113%? So obviously, operating income was down a ton. They were almost $1 billion in operating income to a loss of 64. So guys, overall, it's still not... Yes, they beat expectations and beat earnings, but it's not like, oh, this is awesome. It's just, they went from an operating income to an operating loss. Now, if you believe in AMD long-term, what you need to remember is you're still buying a future cash flowing business. So you still need to price it and value it based on that present value of all future cash flow. Just because a company is growing doesn't mean you go out and buy it at any price. And you might sit there and say, I'm not buying it at any price. Well, if you don't have a process for determining the value of the company, then yes, you are buying it at any price. Because it's not a good deal just because it's from 165 to 60. You have to understand what is the value of the company. So let's go look at analyst estimates before we go into our value. Well, they're expecting good growth here, almost doubling EPS in the next 4 or 5 years. And revenue growth, pretty solid. 24 to 37 billion. It's low to mid double-digit growth. Okay? So let's go to our stock analyzer tool and let's look at this company long-term, because this is the one that's biting at the heels of Intel. This could be the one that replaces Intel. Now, I will say this. The company's market cap is now $100 billion. It used to be almost $300 billion. It was actually $300 billion. And it was doing $20 billion in revenue. That didn't make much sense to me. And of course, everybody said, Paul, you don't get it. AMD is the future. It's amazing. Okay. It very well could be the future. But if you overpay for it, then you're probably going to get stuck or not make as much money, even if you do make money. And that's the thing I'm trying to teach on this channel. If that makes sense to you, if you believe that it's possible to overpay for a good thing, then you're probably a value investor. You just don't realize it yet. If you believe that any price is good for a good thing, then you're probably going to lose a lot of money in the long run, because even though you might have your favorite item that you love, you don't pay $1 billion. Because I'd sit there and say to you, fine, $60, why not 600? Oh, Paul, it's crazy. Well, why is that crazy? If you don't know the value and it's a good thing, pay 600. Why not 6,000 a share? Again, if that's making sense to you, you're probably onto something. So revenue growth, let's go with, I believe the chip industry has a 12% compounded annual growth rate expectation for the next 10 years. So I'm going to go with, let's say people are wrong. Let's go 6, 10, and 14. If they take up more share of that growth. Profit margin, I'm going to go with 10, 15, and 20%. Same with free cash flow, 10, 15, and 20%, which is higher than they've done. PE, 14, 16, 18. 14, 16, and 18 on the price of free cash flow. You know, I sit there and say, well, Paul, it's 30 PE and 30. I get it. But historical average is around 15 or 16. And you have to base it on what the growth potential is at the end of 10 years. This is our terminal value of PE. The terminal value of the company is going to be determined by this PE. So the bigger and bigger and bigger it is, the less growth potential it has. So you have to factor that in there. And finally, for our desired annual return, I'm going to sit here and I'm going to do 13, 15, and 17%. Because it still has some issues that to figure out. So what are the values of the company? And as we go higher in our assumptions, we need to get a higher return. If you just watched our Airbnb video, my highest assumption, I did a 20% desired return because there's so many unknowns on Airbnb. I think there's less unknowns on AMD, and they make a great chip. But let's go figure this out. Analyze button. Boom. All right. Low side 20. High side, basically where it's at today. And middle price 36. I have it on my watch list at 40. This does not mean I'm buying it at 40. This means I'm going to go do more research and make sure I want it. And if I do want it, either buy shares or sell puts at lower prices. So at this price, guys, I would just recommend don't get caught up in the story of it. Get caught up in the story. Go look at the story and say, okay, if this story happens, what's the value? And I think the value is 60 or 70 bucks a share if the story happens. If it doesn't happen, whoopsie daisy. But it's probably going to be somewhere in the middle. And that's the key to analyzing a company. So if you like this, guys, you need to subscribe to the channel because we do so many videos every single week, 20 to 30 videos a week, especially during earnings seasons. There's so many videos out there. I think we're probably over almost close to 1,900 videos on our channel. So subscribe right now. You won't regret it, and you'll walk away smarter with money.